Morning, everybody, and thanks for coming along to our webinar this morning on portfolio management. My name is Jonathan Sheehan. Most of you know me already. I'm going to speak for about 40 minutes this morning on how to structure an investment portfolio, our pension portfolio, from best practice from a diversification and a holistic asset allocation point of view. We were due to run this webinar last night as well, but thanks to a power outage in the whole of the Portmarnock region, we had to cancel that, and we have some attendees from last night joining us this morning. So thanks again for registering. I'm going to start off here by just speaking briefly about the various webinars we've had so far this year. So we had this plan about this time last year that we'd cover off 10 distinct yet interrelated throughout 2021 in terms of financial planning. So this is the 9th of 10. We have our final one next month, which obviously we'll be sending you details on in due course. All of the recordings of these are available on our website in the Insights section. So all the previous webinars are available to you to look back over. And if you need any of the slides from those webinars, just drop us an email and we'll send them on to you. Okay, so let's get right into it. Now, please do ask questions as we go. There is a Q&A button. If you want to put any questions to me as we go, I will try to address them as they come in. If not, I'll aim to cover them off at the end. So planning an investment strategy first. Okay, so I'm trying to simplify this as much as possible, that there's only really 5 distinct options on what to do with capital. The next slide, I'll talk about the different asset class options, but here I'm looking at the capital options. The first one is pay off debt. Okay, so somebody on an expensive interest rate would be more likely to pay off a loan than, say, somebody with a secured tracker mortgage against their property. But it is a very important option for surplus capitalists to pay down debt. Some people have all the debt paid off, so therefore this is no longer an option. But it's a starting point for capital allocation is paying off loans. The next option, this seems very obvious to most of you, I'm sure, is keep it in cash. And actually cash, which we'll see in the later slides, is actually the default option for your capital. So as capital comes in by way of income, for example, from rent or from dividends or from employment income or your 25% lump sum, it doesn't come in the form of equities or bonds or property. It comes in the form of cash. So asset allocation is a constant question, is what to do with my cash. It's rarely a case of what do I do with my equities, unless, of course, you have share options or the majority of your wealth is in private equity or a listed PLC or whatever it might be. So I'm including on post-state savings in this cash decision. The next one is property. So you can allocate funds to physical property. In my experience, this choice is very much dependent on the preferences of the investor, because some people have no interest in dealing with tenants, dealing with the RTB and dealing with paying taxes and repairs and all that goes with the responsibilities of being a landlord or, you know, a commercial landlord in other cases. But it is a distinct option worth pointing out. This next option is an investment portfolio where you say, I will hand this over to a professional investment manager or through the likes of ourselves to structure a liquid, listed, regulated investment portfolio that can include all of the various asset classes, but just in a listed format. So as opposed to having physical property, you know, liquid, listed, regulated funds. And then the last option would be alternatives or private equity. So, you know, there's say people on this webinar who have a large percentage of their wealth would be in one particular company, for example. So that's very important as well to recognize that there is an option also of allocating more capital into private equity, your own business, whatever it might be. In my experience, most people say who are retired, who've worked hard their whole life, would choose not to be getting involved in venture capital My view on it is that one should only be invested in private equity if you actually have an expertise in that sector, and if you're actually adding value to the board of directors or specific advisor of some sort. But if that's not the case, then private equity can be a difficult investment to get into, purely because it's going to be unregulated, the transparency will be less. You need to be very, very up to speed in the industry itself. And it's also highly, highly illiquid, as you know. So they're the capital options for lump sums. This looks like a similar slide, but it breaks it out into specific asset classes. So it's very important, and clients of mine on this call will know that we categorize every single asset that we manage into various asset classes. We actually use level 1 and level 2 asset classes. Level 1 is the high level, and level 2 is more detailed. So the different asset classes are cash, okay? Again, that's obvious, which is currently 0 or negative. The next one is bonds. And some clients here who were dealing with me, say 10 years ago, and those of you who will be dealing with me in 10 years' time, bonds actually do form a very important part of an investment portfolio. But at the moment, cash and bonds are pretty much the same thing because of quantitative easing and yield compression on government and corporate bonds. So I now would say, don't look at cash and bonds as distinct separate asset classes, look at them as one in terms of they have a similar profile. Arguably, cash actually is safer because the yield might actually be higher in cash. Certain government bonds are negative in terms of yield, and cash doesn't incur fees and fund management fees, whereas most bonds would be through a bond fund of some sort. The next one is property. Now that can be, as I said earlier, bricks and mortar property, but also listed property, like a real estate investment trust or a property fund within one of the insurance companies. Another one is equities. So equities are, you can look at the geographical mix, it can be active or passive, it can be in different types of investment securities, which we'll talk about later on. But equities themselves are an asset class in their own right. And some people say, well, no, I mean, European equities are different to US equities, are different to Far East equities. The reality is that there will be certain years where certain geographies or sectors will outperform, but generally listed equities will have the same characteristics regardless of where they're invested. Private equity, as I said earlier, and alternatives are any asset that are not one of the previous 5. So the obvious one at the moment would be the likes of cryptocurrency. There's absolute return funds. I put commodities in there, but alternatives generally will form a very small percentage of an overall portfolio. The purpose of this slide is really to simplify everything, because you can get all sorts of fancy brochures and information memorandums and all these different things, and complicated investment managers talk about this fund and correlation and all this kind of technical jargon. But the reality is your assets are going to be in one of these 6 asset classes. And we use multi-asset funds, a bit risk-weighted multi-asset funds. Multi-asset isn't a distinct asset class. It's actually just a combination of some of these. So just remember, when you're making decisions on where to park capital, it has to really fit into one of these. Which brings us on neatly to the next slide is, you know, your capital has to be allocated somewhere. So people who put their head in the sand and say, oh, you know, things are too volatile at the moment, or I'm going to wait until I retire my pension to make a decision, or I'm going to put off making a decision for some particular reason. The reality is that capital has to go somewhere. As I said earlier, the default is cash. So that's fine if your risk profile is commensurate with a high cash rating, but you need to understand that your asset allocation needs to be linked to what your objectives and your risk profile is. Your circumstances as an investor, and there's some professional referrers here also, accountants and tax advisors on this webinar. When you're speaking to your clients, the one constant is change. So the circumstances of the individual or the family will always change. Every year we're getting 1 year older. Your risk profile might change. You might have capital come in from a certain sale or from a retirement. So you can trust me on this, from dealing with clients for over 15 years at different times of their lives. your circumstances will never stay the same. That's why it's always very important to keep on top of it. But also the prevailing market landscape changes as well. Who would have thought a number of years ago that we'd be in this long period of negligible interest rates where you can get nothing on cash or even negative yield on cash? Who would have thought 18 months ago that equity markets would be at all-time highs given what's happened with coronavirus? So it's very, very important to keep on top dynamically of what your circumstances are and what the prevailing market is. And understanding risk is actually the most important thing. So your asset allocation will depend on, firstly, your own preferences. So some people, as I said earlier, will have a preference for buying bricks and mortar property, will run a mile from that type of thing. So some people are very risk aware, and they would say, well, if I'm 15 years from retirement, I have no problem being fully invested in equities because I have the time to recoup any losses that short-term volatility might be. Other people say, I have no interest in individual shares. I have no interest in active funds. I'd rather ETFs or whatever it might be. So knowing your preferences is very important. And I suppose our role is also an educator to, talk to you about the options and understand your preferences to explain them in the clearest way. Second circle there is market conditions, which I touched on earlier. Market conditions change all the time on a minute-by-minute basis, on an hour-by-hour basis, week by week, month by month, year by year. So it's all well and good having your preferences, but you need to know what the market is doing as well at the same time. Risk profile, extremely important, obviously. You need to understand your appetite to risk, capacity for risk, and tolerance of risk. So just because you might have a high appetite to risk, you may actually have a very low capacity of risk. So our job, I suppose, is to marry that and make sure that your risk profile is commensurate with your portfolio. And time horizon is important. We look after a lot of charities actually here in Compass. And if you think about a charity, the objective of the charity is to be evergreen and to have no expiry date. So a charity we look after today is hoping to be around in 50, 100 years time. And in some guys, it most likely will be. So the time horizon of a charity is actually the ultra long-term. Time horizon of someone below the age of 50 or 55 is quite long actually, because they may have at least a 10-year, 15-year time horizon before they need their capital. And even for people who are in their late 60s, 70s, and even 80s, if they have ring-fenced a portion of their capital for the next generation, or even the next generation beyond that, they have a long-term time horizon for that part of their capital. And ultimately, the longer-term time horizon an investor has, the more risk you can be comfortable with taking, because when we see the market downturns and sell-offs and corrections, that has less implications for you if you have a longer-term time horizon. We got a query recently where somebody said, I've got X amount of money, I'm most likely buying a property, or we're buying a property in, say, the next 2 years. So we will need it back then, but I don't want to be leaving it on deposit for the next 2 years. And we actually turned down that business because it didn't make sense, them investing it for 2 years, because 2 years is too risky. We're at close to all-time highs. You need to have at least a 5-year time horizon with anything you put into an asset other than cash at the moment. So this goes back to the basic question, why would you invest? It's to generate growth in capital or income in excess of the risk-free rate of return. Very simple. And because we're entering into this inflationary environment, to make sure that the real value of your capital keeps up with that. So, there's alarming rates of inflation at the moment in Ireland, Europe, and different jurisdictions. Where that's going to be next year, we don't know. It could be between 4 and 5% in Ireland next year. The expectation and the hope is that this inflation will be temporary. But even if it is temporary, if we're running at inflation of 4 or 5% for the next 5 years, you're looking at 20% loss in value of your capital, assuming your capital earns no interest. So it's very, very important for parts of your capital to make sure it's working for you without taking unnecessary risk. And for anybody here who's approaching retirement or in retirement, your capital really is to fund your retirement years, so you don't have to go back to earn income, whereas you can get it from passive income sources. Also, as a succession plan for the next generation, that's very important for those who have surplus capital for their needs in their lifetime to ring fence funds for the next generation, have a separate mandate for those funds. So why shouldn't you invest? Very simply, if you have a low tolerance for risk, appetite to risk, or capacity for risk. So if any of one or two of those is low, then you need to really understand, is it worth taking a risk with your capital? And as I said earlier, you shouldn't invest your capital if you don't have a medium to long-term time horizon. Now, I've talked about cash, and I'm going to talk about it again here, okay? So it is the default for your surplus cash flow and savings. And anything that isn't cash is also ultimately prone to drops in capital value. And that's ultimately why it's labeled as a risk asset. Now, if you kept all your money in cash and you had a 20-year time horizon, obviously the value of that cash is going to be depleted over time if there's any bit of inflation. So just because your money is in cash, it doesn't mean it's not risky. So you need to understand the risk of cash and risk assets also. But cash is important as a building block in the first layer of any portfolio. It can be an emergency fund or an opportunity fund, but also a natural diversifier. So if somebody comes to me and says, look, I have X amount put away in cash or on post, and that's my safe money, it enables me to take more risk or recommend riskier investments with their non-cash capital, because I know that their low risk piece of their pie is already boxed off through having cash. The amount of cash you have is dependent on security of your income, your risk profile and age, your cash flow surplus or your cash flow deficit, and other invested assets. So this is where, I suppose for a lot of younger professionals, say below the age of 40, I'm calling them young because I turned 40 this year, so anybody below 40 is young in my mind. But anybody below 40, or most people below 40 now, or even 45, their financial planning is actually quite simple. It's, they'd have a relatively fixed income through, employment or self-employment or whatever it might be. So between a husband and wife, there'd be a certain amount coming in that gets taxed at source. They're left with a certain amount, and most of those people have mortgage payments, they're paying AVCs into their pensions, they might have childcare for the kids, or they'd have different household costs, and there aren't that many decisions to make. The only decisions for them to make might be to switch their mortgage or to top up their AVCs. It's not till people get kind of above the age of 50 where they might find, okay, well, the mortgage is now either paid off or it's under control. I now have increased earnings because I'm now making more money than I did when I was in my 30s. So they run into what they call a surplus, either cash flow surplus or capital surplus. And that's where planning becomes more and more important. And there's a reason why I think in Compass, outside of our charities, obviously, which we don't have a particular age for, but the average age of our clients is probably 58 or 59, because planning becomes more important as you get older. If you're below the age of 50, planning is important if you're running a significant cash flow surplus or capital surplus. But every year going forward, then planning actually becomes more and more important. Diversification. I have an article coming out this Sunday, actually, in the Sunday Times. I hope it's this Sunday, either this Sunday or the following Sunday, on portfolio management and diversification. So I'll make sure we send you a copy of that. But there's ways where you can diversify. So the obvious way is asset class. So putting your funds into, have some in cash or on post or bonds, equities, property, the various asset classes we showed earlier. Another is investment type. So even within an asset class, let's say you had your equity exposure, it needs to be diversified in terms of the type of investment types, which we'll talk about in a later slide. The sector. So you could say, well, I've got 50% of my wealth in equities, but if that's all 50% in tech companies in the NASDAQ and the US, that wouldn't be very diversified. So you need to make sure you're diversified across sector as well. Liquid and illiquid, there's no problem having bricks and mortar property that's illiquid if you have enough liquid capital to fund any cash flow needs you may have. No problem putting clients into a long-term investment portfolio if they don't need that capital in the next 5 or 10 years. So having a mix of liquid and illiquid is fine too. We actually use, some of you will be aware of it, the Section 73 policy, which is actually an 8-year commitment, which is a regular premium investment fund that you put money into every month. But you need to do it for 8 years for it to become tax efficient for Section 73. We will be covering tax in November's webinar, so I won't bore you with the detail of that now. But the point here is that having liquid and illiquid within an investment portfolio is important. Growth versus income focused. So some assets you're buying or investing just to grow the capital. Others investing and say, well, I want a 3 or 4% income yield from this every year. So having a mix of the different types is important. Custodian provider. Again, you could say, well, I'm very diversified because I have lots of different asset classes, lots of different investment types, lots of different sectors, but all my money is with stockbroker A. Well, I would say that's absolute madness. You can't put all your eggs in one basket, and in particular, which we've seen over the last period where different, events have happened to different entities, let's just say, and also a lot of mergers and acquisitions clients of mine are sick of me constantly writing to them to say, this institution has now been taken over by this institution. And we've seen obviously with KBC at the moment, with Bank of Ireland. So now if you had some cash in KBC and some Bank of Ireland, that'll be redundant, for example, from whenever that takes place. And geography. So just because we're Irish, it doesn't mean that we should have all our money invested in Ireland. But equally, a lot of people in Ireland are very, very much impacted by what's happening in the States. They may work for a US multinational. The classic case is somebody works for Facebook or Google. And they're seeing what's happening in the US all the time, and all their share options or their vested shares are with that particular PLC, which is a US company. So just to make sure that your geographical mix is well spread also. Broadly speaking, what I like about this is that if you put the profile of assets into a risk and return chart, ultimately, all else being equal, the more risk you take, the more your target return should be. So, if you're investing in a cryptocurrency, that's extremely high risk in one way, but at the same time, your target return expectations should be higher than if you put the money into on post. Now, the next chart is similar to this chart. The bonds and the equities are now the same on the very bottom left of the chart. And that's just the current environment. Bonds have become pretty much, I wouldn't say an uninvestable asset class, but it means that your exposure to bonds should be a lot less than it would be in a normal interest rate environment, because the characteristics now are pretty much the same as cash. Okay, now you know everything about the big picture. Now, how do you actually structure a portfolio? Where do you place the money? Frankly, with Compass, we work with all providers. It doesn't matter to us where the money is. We have our engagement directly with the client, but here are the options. You can go directly into a fund. You can use a low-cost online broker. Caveat emptor here. Don't expect the Rolls Royce of service and reporting. Don't expect the low-cost online broker you deal with to not be sold to a private equity firm 3 times in the next 5 years. And don't expect changes, Brexit not to affect it, whatever it is. So low-cost online brokers is fine for your smartphone for 10 grand or whatever it is, but just be very mindful of larger amounts into platforms like that. Unregulated syndicates. For me, it's just not a runner. I don't recommend them. If it's unregulated, your level of transparency is minimal, and we've seen issues this year, actually, even in Ireland, and in previous years, with people losing all of their money in unregulated syndicates. So just steer clear of them. Would be my advice. MiFID stockbrokers, so they're the big institutions which we deal with, which are important for custody of assets. Life insurance companies, probably lower cost, probably the lowest cost option for getting exposure, definitely for pensions because they bundle all your fees into one clean pricing structure. So life companies would be kind of the simplest, but if you wanted to phone some of the life companies and say, the market's open at 8 a.m. tomorrow, what do you think I should buy? You're not going to get that level of service. And retail banks would obviously be for cash deposits. Their offering for investment services is quite poor, in my opinion. So our role is to ultimately, we can report and advise on all of these structures, kind of with the caveat of the unregulated syndicates. We wouldn't really go near them, but the other ones, I think it's important to have a good mix of all of these. So the types of investments which I mentioned earlier, the first is a fund. A fund is a collective investment vehicle. So most of you here will be very familiar with funds, and funds form an important part of your portfolio as it is. These are funds that are actively managed. The next one is a fund that's passively managed, which means that the fund, which is an exchange traded fund, simply just buys the market. So we would say, okay, let's invest in a fund that'll just buy the MSCI World Index. Whatever the world stock market does, the index tracker, the ETF will track that. Individual shares and bonds, which can be bought as part of a portfolio. So you can have part of your portfolio in direct individual shares or bonds, syndicates or SPVs, and then a direct investment, which you say, I'm going to just bypass a fund manager, just buy that commercial building directly myself. So rather than going to fund, I'm just going to buy it myself. So just ETFs, I touched on there. These passively track an index. Their objective is just to replicate the performance of an index rather than beat it. So an ETF is doing its job. If I can look at the MSCI Eurostoxx index did 7.4%, and the ETF that my client has also did 7.4%. In a downturn, the risk, the disadvantage of an ETF is that if you put all your money into an ETF now and the index falls by 20%, your ETF is going to fall by 20%. There's no downside protection. Whereas in fairness, an active fund manager would say that, well, in a bear market or a sell-off, their job is to, maybe actively trade on the way down and then be in a position to guess when the bottom of the market is to buy back in. So one would expect in a across the board sell-off of 20%, an ETF would be down by 20%, whereas an active fund wouldn't be down by 20% at all. The main is that ETFs are lower cost than an active fund. If you want to buy them personally, they're very tax inefficient. Again, we'll cover this off next month. ETFs can be bought through a platform. They can be bought through a stockbroker or through insurance companies. So 5 years ago, I don't think any of the insurance companies in Ireland offered the passive option, but now I pretty much three of the 5 insurance companies do offer the passive option now. So it's great. Tax implications, again, I won't go into too much detail here. It is important to have some information for today, but we will cover this off next month. Gains are going to be subject to either capital gains tax or exit tax. So you need to know, now for pensions, it doesn't matter because pensions are tax-free anyway, but for non-pension investing, each investment you're in is going to be subject to CGT or exit tax. The exit tax is chargeable after 8 years, even if the investor doesn't sell out. And all shares are subject to capital gains tax, whereas collective funds are subject to the 41% rate. So there's a bit more detail there. You have to be very, very careful of tax and investing in Ireland. I would love more so than anything in the world to sit in front of whoever the people are in the revenue in Ireland and explain to them the complications that they create by having 2 different tax structures. It really, really doesn't make life easy, unfortunately, for our clients. hopefully there'll be more clarity in due course, but either way, if you're investing money personally, you have to understand the tax implications of it and how it's suitable for your particular tax circumstances. And here's a table here. Some people would say, oh, well, CGT, it's better because the rate of 33% is less, but it's not that easy. The 41% exit tax actually is more suitable for certain clients, depending on the investment amount and depending on what their investment mandate is. So again, we'll talk to you about this today, specific cases. I can see a question coming in there. We're going to wrap this up in about 4 or 5 minutes. So keep coming with the questions. Just type into the Q&A tab any questions and I'll address them at the end. Investing through your pension is better ultimately because there's no tax on the growth within your pension and you get tax relief going in. So if you are investing, maximize the pension first and foremost with higher risk, and your non-pension assets should be disproportionately more lower risk, but only invest personal money once your pension is capped out as such. So again, tax implications of pensions, we'll touch on that next week. Just one slide here on the investment markets at the moment. Interest rates are globally at historic lows. In my 15 years in this industry, and hopefully I'll have another 25 or 30 years, I would say that this is the most challenging environment in terms of where to invest your capital because there's no obvious place anymore. It's made us busier and it's made the choice for investors more difficult because you leave it in cash above $1 million, you're earning negative. If it's below $1 million, you're earning zero. That $1 million threshold could come down to 500,000 easily. But it just means that if you leave everything cash, you're earning nothing. If you put it into an S&P 500 ETF tracker, you're buying in at an all-time high. If you're buying residential property in Ireland, you're buying in at close to all-time highs as well, when the support for tenants are stronger than it ever has been before, with potentially different government coming in. So it does make it more and more difficult. So please do talk to us about your own specific circumstances. Equities are extremely, I suppose, uncertain. We had huge volatility last year, and we're looking forward to a lot of unpredictability at the moment, given that we are facing a lot of unknowns about what's going to happen with COVID, what's going to happen with employment, what's going to happen with interest rates and quantitative easing and different things. Bonds and fixed income, it's the same asset class. We're now looking at this as pretty much an uninvestable asset class due to the way yields have been depressed. So in a normal environment, a client could say to me, you know what, Jonathan, I've done the risk questionnaire. I've looked at my tolerance for risk, my capacity for risk. I think I'm low to medium, so I'm just going to throw all my money into a bond fund. And I'm pretty sure of getting a 2.5% to 3% yield on an annual basis. Well, that asset class isn't there anymore. Well, the asset class is there, but your yield is going to be 0, or maybe 0.5% if you're lucky. So that doesn't form part of a portfolio anymore in the way it would ordinarily be. Yes, we go back to that as an asset class in maybe 3, 4, 5 years, but at the moment it's just not an option. And property is very much dependent on the income yield and the security of the income. So just be conscious of time lag and property valuations, both in a rising market and a falling market. Property is important to have some exposure to. Most of our clients prefer to have it through a listed exposure as opposed to bricks and mortar property. Timing is working out well. 37 minutes past. I'll spend a couple of minutes here in summary, and then please do ask any questions which we'll cover off. Summary, key principles. Please diversify. Clients of mine who are used to me saying diversify will hear me say that forevermore. It's so important to be diversified. Always think big picture. Don't come to someone like me or another investment advisor and say, here's my pension, I'll fill out a risk profile just for my pension. That's madness. You need to look at the entire big picture and how your pension fits into your non-pension assets. For a couple or family to look at all of your assets together into one holistic pie chart. Clear mandate, so make sure that you know what your expectations are, what your asset allocation is going to be. Make sure that you're clear, us as advisors are clear, and any third-party managers we use are clear. Transparency, one shouldn't have capital deployed unless it's fully transparent and they understand it. Inertia, don't fall into the inertia trap. So because of the abundance of paperwork, a lot of people put off making decisions. I would say be proactive. If a decision needs to be made, make it. Set up that Section 73 policy if it means you're deploying capital into the market and you benefit from the gift tax exemption or reduction after 8 years. Do these things, be proactive. And always avoid conflict of interest. Don't take advice from someone who you don't trust, frankly, and make sure that the interests of the advisor or the institution are aligned to yours. Holistic planning. Financial planning is separate yet related to your portfolio management strategy. So it's important also to look at your overall position. This goes back to the holistic view. Your full schedule of assets and liabilities. Know what your income and outgoings are. So once you understand your financial position, what are your objectives and goals? When do you want to retire? What is your strategy? What's your risk profile? What are your concerns? What are your preferences? Do you have ESG mandate, environmental, social governance preferences? And then once you have all that, work with us in terms of making sure that the actions we put in place, the solutions we put in place are commensurate with your financial circumstances. That's it. Thank you very much for joining us. I am going to now address a couple of questions that have come in. What's my view on interest rates? Very difficult to know. I know that central banks are saying that they believe it's going to be temporary, that we've seen these supply chain issues and we've seen these rises because what happened was in February 2020, global supply and global demand roughly met each other and were on a par with each other. And then we had COVID and lockdowns. And if this is demand reduced significantly, but supply stayed where it was. And throughout the course of 2020, demand remained subdued and maybe started increasing a bit, and supply massively reduced. We had issues like the Suez Canal, we've had issues with social distancing, but we've had issues with, in Ireland, the pandemic unemployment benefits. So people said there's not much point in going back to work from getting 350 euros, a week. So what then happened was supply reduced massively, and then since we've had the vaccines and we've seen demand shoot right back up with a surplus of savings, and now supply is down here. And supply is trying to get up, but demand is probably also going back up. So what that's created is a surplus of demand, which has obviously boosted inflation. What central banks are trying to say is that, yeah, well, it's going to be a matter of time before the markets work it out and supply and demand get back to level. But we don't know. That might take 2, 3, 4 years. It may not. We may go into a prolonged period of inflation. Interest rates will be adjusted to curb inflation. So if inflation is high consistently, so let's say inflation got to over 5% in Europe next year, what the central banks then do is they say, now let's pull our lever. Our lever is raising interest rates, because if they raise the overnight rate of deposit from minus 0.5 at the moment, and over the course of 12 months, if they bring that right back up, say to 2%, for example, probably wouldn't be that dramatic, but let's say they did that. By increasing it to 2%, what they're then doing is they're then rewarding people who keep the money on deposit and savings, which is what they want, because they want to slow down spending and investment. And they're also penalizing borrowers whose interest rates are linked to the ECB or Euribor or whatever it is. So interest rates are a great lever for central banks to increase, to curb spending and encourage saving. And then if ever we got to a stage where we were looking at the economy needed a stimulus, and when interest rates were at 4.25%, which is where they were only about 10, 12 years ago, they then have the lever to say, now we're going to reduce interest rates to ultimately encourage people to take money off deposit and spend or invest it, and to make borrowing cheaper so that people will actually borrow money to invest or whatever it might be. So that's a long-winded answer to say that I don't really know what's going to happen with inflation, interest rates. The truth is nobody knows. I think that we will see inflation. That's guaranteed. When interest rates increase in Europe to accommodate that, we just don't know at this point in time. Most likely 2023, going into 2024. But remember, a risk for all of you here on this webinar, you're all living in Ireland, you're Irish residents, you're Irish taxpayers, your assets are based in Ireland. One of the issues is that interest rates will need to be adjusted up in Ireland, but the European Central Bank choose not to do that. So the Irish interest rate is dependent on Europe, and therefore they may not be the same. They may not be the same interest. So that's one issue that we saw in the past. In 2006, when the ECB raised rates were 2%, and Ireland was losing the run of itself. In fact, if we had control of it in Ireland, the rate should have been 4 or 5%. And equally, when they hiked rates right up after that, in Ireland, we needed rates to be down at 0 at that stage, and they were up at 3 or 4%. So we have to be mindful of that. The next one is, how much cash should I keep on deposit? I can't answer that specific to any individual, but it'll depend on your own circumstances. We had a slide earlier in terms of the security of your income, your other assets, but it's important that you have access to a certain amount of capital at all times, both as an opportunity fund to say, well, I have now decided to do a couple of $100,000 worth of work to the house, or to buy an apartment for my child because he or she will be potentially going to UCC or Trinity or whatever it is. We want a property or whatever it might be. That's not an emergency fund, nest egg needs. That's actually an opportunity fund. But you can have that capital there once it's liquid. I think that making sure you have at least 6 or 12 months of outgoings boxed off in an account in cash would be more than sufficient. So it's 45 minutes past 10. That's it. I really appreciate all of you registering for this webinar today. Thank you very much. We'll send the slides out later today and the recording, and we'll send you invites for our November webinar. And that's it. Please do check out our new website as well with our content library and our insight section.